All right. Hello, everyone. So welcome to today's webinar brought to you by Bursa Malaysia and managed by Lifetime. So the topic for our webinar today is build passive income with exchange traded bonds and Sukuk. Once again, welcome to the session. I am Carmen and I will be the moderator for today. So before we move on, allow me to do a little bit of disclaimer. All right. So please do take note that everything that is mentioned in this session is mainly for educational purpose. In no way that we are providing any recommendation to buy or sell any securities that is mentioned here. So be reminded that you are 100% responsible for all the risks if you make any investment decision. So without further ado, allow me to introduce Mr. Dibocha, who is our speaker for the day. So he is an investment and finance and investment professional with a bachelor degree in finance and investment, and has completed level 3 of CFA exam, showing his passion towards investment banking. On top of that, over 5 years of investment experience, he has focused on Malaysian and American stocks, commodities, and index futures, and utilizes fundamentals and technical analysis. In addition to that, over 1 year of experience in teaching investment, he has managed to taught over 500 students. And last but not least, he is also proficient in wealth management and financial planning. So without further ado, please welcome Mr. Dibocha to our webinar today.
Hello. Can you hear me clearly?
Yeah, we can hear you very clearly. Yep.
All right. Okay.
Right.
Thank you, Kaman. Thank you for the very quick introduction of me. So I will share the screen right now. Just give me a moment.
Yep. All right. So I'll pass the floor to you.
Yep. Okay. Wait a while. All right. Okay, I think everyone can see my screen right now, right? So it's gonna be, everything is good. Okay, so thank you, Carmen, just now for a quick introduction. So my name is Debo. So I'll be the speaker today about this bond things. Okay, so a lot of times we do heard a lot about bonds, Sukuk, in Malaysia. So sometimes we read about news. Also, we can, read about things like a company raise up funds of perpetual bond, perpetual Sukuk. So to be honest, what is actually this bond things, and what is actually this Sukuk? How can they actually help us? For example, like us, retail investors. How can it actually help us? To be honest, if you try to understand about Sukuk, right, and you try to understand about bonds, if you read a lot about these finance books, you can understand that bonds is actually a very good thing, whereby it's actually brother and sisters with a totally different personalities to equities. Okay, which is what is called stocks. So a lot of times, if you know about like Warren Buffett, he always says that in his book, An Intelligent Investors. So what he says that in the whole world, like we have thousands of investment vehicles, investment tools, but if you try to break it down, the easiest part to make a portfolio management, it will be stocks and bonds. So these are the only two things, because these are the only two things that actually helps you in all kind of economy periods and in all kind of economic circumstances. So today we'll learn about bonds and Sukuk, the basic of it. And then if you guys have any questions, or you guys have any practical example that you kind of like not to understand about maybe bonds, or maybe sometimes you heard about bond funds, so you can just spend it up to me. Okay, so today learning's outcomes, we'll talk about very briefly what are bonds, what are Sukuk, the basic features of bonds. Okay, bonds can be very confusing sometimes because it has a lot of similar terms like yield, interest, and all these things, but sometimes I will tell you what are the difference of all of these features. Okay, and then how can you start to invest in bonds? Okay, like I said just now, it can help you to build up a very good, efficient portfolio. Okay, so let's not drag too much of it. We'll start right now. Okay, so the first thing first, we'll talk about what are bonds and Sukuk. Okay, so if you want to talk about bonds, right, we will first have to understand about how companies actually raise their funds. Okay, being said, like for this example, I believe everyone knows about this company, Tenaga Nasional. So basically, what they provide is they provide electricity to all of us, or to business and all this retail household, all of us. So their business, in normal times, a business we will have all this kind of things lah. If you want to really raise about capitals to go and expand your business, or maybe like put up even more generation power, okay, put up even more generation power plant, something like that, you can actually raise fund, okay, either by equity, which is you actually ask more of the investors. Maybe sometimes right now you are looking at government, okay, you ask about government whether they want to support you or not, whether you ask about the other country as well, maybe other countries, other governments, whether they want to support you or not. But that kind of things, because if you're asking from someone and you have to give them some things, right? Because they give you the capital, takkan they just like give you the capital and expect nothing. So you have to give them something. So definitely you have to give them maybe equity in shares lah. So they will have this ownership. So this is the bad thing, like for Tenaga, because if you are the owner of Tenagas, you will try to keep on the control under your hand, okay, so that the things will not go off. Suddenly people coming in saying that they have more shares holding compared to you, maybe like 30%, you're having like 20%. So they want to snag you off. So this is the bad thing for business owner when they think about raising funds. So instead of raising funds from this side, you can do it the other way, which is actually the traditional way, going from the bank. Okay, you go to the bank, you can get a loan. But this is the things that come in very tricky, because the banks, they're always very demanding, right? Like if you have ever experience going to bank, try to get a mortgage loan, they're always very demanding. They will ask you about all the secret things and all your credit things. And at the end, you try to nego for lower interest. They always say, no. They always tell you that this is the lowest interest, but somehow when you heard from the other friends, then they will tell you that they're having a lower interest. But this is a bad thing. So this traditional way is very tedious also for the company. So instead of going these two ways, we can go a new ways is this, which is debts, bonds. Okay, so instead of the debts, this part as we see here, the right hand is the equity, which is shares, and then the left hand side is debt. Debt, although we think about it, is thinking about the banking side of the debts, but instead of taking the bank side of the debts, taking a loan from the banks, we can actually raise up bonds from investors. So this time around, it's also still around from investors, like from government, Malaysia government, other countries' government, like others institution. But this time around, we are using bonds instead of like shares. So we'll give them the bonds, and then they will give us the capital. So the bond is somehow is like a ownership. But this kind of ownership is not the ownership to have the shares of the company. It's a different way. So this is how bonds, use for all this kind of companies and corporates like that. Okay. So typically, just now is just a basic, an introduction. Okay, what is bond? So right now we'll look at even more details, like how can you look at bonds? Okay. So as I say, a bonds is actually you are getting the capital from investors. You can sometimes call it lender as well, because sometimes it acts almost like a bank like that. But typically, these people, they won't be the kacha time. What they keep on asking you to have, like whether your secrets, give me a look, have a look, whether your asset can pledge it or not. All these things. It's all about you give up the condition to us, and then we will think about it, whether it's a good bond or a bad bond, something like that. So being investor, they will think about it themselves. So the first way of it is like the investor will then analyze, and then having their own due diligence, they will do up their own analysis. So if they think that, okay, this company is quite good, so they think that you are having a very bright future, they can actually invest in you. So okay they say that they actually invest. So they lend the fund, they invest, they give you the capitals. So they give you the capitals. This is the bond issuers, which is like just now the example, the Tenaga like that. Okay, Tenagas being the bond issuers. Okay, so from there, they take up the capital. So they're able to have this capital already. They go and expand their business. They put up bigger projects, bigger development, and all these things, growing the business up. And definitely once their project is successful, right, they will generate the income. So this is the third step, right? Okay, they generate the income and then they give you back the interest, which is to say that they actually use your capital to go and expand their business. The business gives them the income, and then in return to you as an investor, okay, they will give you a periodic interest, okay, by every year. Okay, so this is how a bond looks like. Okay, typically it's almost like a bank loans, but this time around, the lender itself is actually like investors, like you, me, institution, everyone. Doesn't necessarily be the bank like that. Even bank can be the bond investors as well. So this is the interesting things lah. Okay. And then we will have another terms of the bond, which is called sukuk. Okay, sukuk. So what is actually sukuk means then? Are they the same thing? It's not. They are not the same thing. Okay. Reason being, sukuk is actually the Islamic terms for bonds. Okay. It acts almost like the same things, which is they give you, you as the investor, you give the capital to the issuer, and then the issuer go and expand, and they get income, they give you interest. It's almost the same thing like this lah. But the only difference that the sukuk has, it's like the evidence of ownership. Okay, the evidence of ownership. This is very important. Okay, because for bond itself, a normal bond, or what we call conventional bond, okay, which is not the Islamic type, you actually don't have the ownership of the assets. Okay, you don't have the ownership of the assets. Okay, meaning to say, if we put it plainly to say, if something happens to this project, you will only get back the asset value. You know, like if this companies they bankrupt, only they're bankrupt, then you were able to get the assets back. Whether what kind of value they have, then they only give it back to you. But in sukuk, it's a different thing because you have the ownership of it. Meaning to say, if the project fails, you as the sukuk owner, sukuk holder, you will directly having the ownership on this particular project. So the particular project, it has to be sold off, and then it has to give back the value to you, whatever it is, on that particular project only. So although it's a bit confusing, but you can just think of it. It's like it's a totally same thing. It's more like when they structure up the sukuk, they will have to like put up another special company. It's what we call a special vehicle company. They have to put up a special company and then try to control, try to like take control of this process, being the ownership of it, something like that. So this is sukuk. Okay, it's so totally the same thing as bond. It's just another terms of it, but it's a different word. Okay, but definitely there is a very special things being sukuk. Usually you don't see a lot of banks they will issue up sukuk except the Islamic bank. Okay, except the Islamic bank. A lot of banks they don't have sukuk. Only if they have this Islamic operations one. But if let's say they are just a normal conventional bank, they don't have sukuk one. Because sukuk is supposedly to have only in this kind of Islamic companies. So if you look at like Heineken, they definitely cannot put up sukuks one. Because their business themselves is actually like haram already, so they cannot put up like sukus. So this is also a thing to remember. So instead, like if you one day some kind of bankers they actually tell you to buy Heineken's suku, then it's kind of crazy things. Okay. And then we'll look at bonds. In the old days, it's very interesting. Okay, bonds is actually not like something that is very magical. Okay, in the old days, it's actually something physical. You can actually touch on it. So in the old days, it's very funny because if you buy on some companies' bonds, they actually give you the bond certificate, and then the certificate actually comes with this coupon. Okay, the coupon is almost like our domino voucher like that. Okay, at the bottom of it. Okay, so the coupon they will have a lot of different dates. Okay, they have different dates. So once you reach that date, you actually can tear it up, and then you can go to the bank, okay, and try to claim your interest back. Okay, so this is what it's quite interesting in the back. Okay, back then, in the old days like that. Okay, but nowadays, everything is digitalized. Our bonds is definitely a different way now. Okay, we don't have this certificate anymore. Okay, our bonds nowadays we only in digital, so it's basically like a name. Okay, so here as we can see, I have this MGS, Malaysia Government Securities, and then I have this again MK, which is this actually I can't don't remember what bond is this, but I will tell you like how can we understand what is this bond means lah. Okay, so typically the bonds usually they will code it as this way. Okay, the first alphabets, like the first group of alphabets is basically the bond names. Okay, which is this MGS, meaning like Malaysia Government Securities, meaning our Malaysian government bonds. Okay, and then they will then comes with a group of interests. Okay, so in this case it's 3.759. Okay, this is actually the coupon. Okay, the coupon of the bonds. Okay, so I will tell you what is the coupon means later. Okay, and then the third group of it is the date. Okay, this date is actually the maturity date. Okay, meaning to say, for example, maybe this bond is around 15 March 2017 when you look at it. So if you look at the date of it is 15 March 2019, then you know this bond actually have like 2 years of period. Okay, after they reach on the period, then they will give you everything back. They will give you the principal back. Okay, and then the last one, it will be the type of it. So this one, as you can see, it's GOVP, government. So meaning to say it's a government bond. And then this is the MYR in terms of Malaysian ringgit currency. So as for the bottom one, it's also the same thing. So this is actually a company bond. Okay, I can't remember this company names, so I'm sorry about that. Coupon 4.78%, and maturity date 31st of March 2022. Okay, last year. And this is the type, the corporate bond, okay, and currency. Okay, so this is how our bonds is look like today. Okay, and typically you can have the understanding being said, because as you can see here is government, so meaning to say government themselves, they can actually issue bond as well. So this is also another way how government they actually have fundings, they can put up projects, big development mega projects and all these things. So a lot of times it's more using the bonds to get on fundings and all this. Okay, and then we will understand about why do the corporate issue the bonds. Okay, why actually they want to issue up the bonds. So just now I mentioned a bit of it like the bonds, because if you raise fund using equity, then you are actually giving out controls. You are actually giving out ownerships to other people. But if you're using bonds, they don't actually own your business. They don't actually own your business. They only own the assets when you actually bankrupt. When you actually bankrupt, then they will come to you. They say, "Oh, I want to claim, my bond value." Okay, that is the only thing. So basically, if your company, if your business can run smoothly for the long term, you don't have to worry lah. So this is the key thing why corporate actually issue bonds. It's a much more better way. Okay, and then the second thing, it's about the cost of funding. Okay, it's also pretty low as compared to stocks. Okay, how do we say so? If you compare, using equity, it's a lot higher in terms of cost of funding. Okay, this is how we explain it. Like, if you imagine, right now I'm raising a funds using equity, and if my project is actually going really well, okay, my project is actually going really well, I actually earn quite a lot using the capital I have raised from equity, from shares. But the thing about it is, like, you as the shares owner, then you will start to have, start to being greedy already. Because right now you look at the project, you know that, oh, my investment on these shares is actually successful. So you'll try to demand more returns from the company, being like, hey, try to give me more dividend lah. Right now you earning so much already, try to give more dividend. If you can't make it, I sell your shares lah. I can't take it. So if you look at this way, the cost of funding from equity is actually very costly, because if you want to fulfill their needs, their wants, you want to fulfill their appetite, right? It's actually very hard things to do, because you give up first year dividend. Like maybe right now you try to be conservative a bit. You nego with them saying you give only 3% dividend. The next year, your project is doing even better. They're definitely not satisfied with 3% anymore. They'll ask you to give up higher, maybe 5%, 6%. Then the third year again, you do even better, even stronger. Now they were not asking for like 6%. They're asking even higher and higher, crazily higher. So this is why cost of funding from equity, from the shares is very high. From bonds itself is very, very low, and it's very helpful for the companies. Okay. And then the second thing, the last thing, just now I talked about this ownership already. So the last thing about it is the interest on the bond is also having quite a good thing in terms of deductible. Okay, in terms of the income tax. This is slightly technical if you really want to find how they actually helps on income tax. But to say another way, it's easier to put it is like, if you compare using only the equity and also using bonds, you'll find that the tax payment in terms of the company that actually raised by using bonds, it will have a lower tax payment as compared to the one that using shares. So this is how it actually will shows you, for a company. So you will actually save up in terms of tax payment, something like that. Okay. Okay, and then right now we'll look at how our bond actually price. Okay, how they actually price. Okay, typically, just now we are talking about the bonds history and how bonds is actually works and all these things, and what are their benefits and what are their weakness, something like that. So right now, if you look at it, bonds, we have all these terms. It's very, very technical. They have a lot of terms. Okay, but simply to put, bonds, when we raise bonds, we call it the par value. Okay, and then the par value will always start at 100. Okay, the par value will always start at 100, meaning to say the face value of it. Okay, so this face value, it will goes up and goes down one. Okay, at the beginning it will be definitely 100. After that, once they raise up, you as the bondholder, when you're holding it, you can actually trade it. Okay, you can actually trade it, meaning to say, if right now you are very urgent, you need the capital. Okay, because bond as a instrument, you lend out the money, and then you get it in return, you get up interest back every year. And then once they mature, right, then you're able to get back all the principal back at once. But maybe in the midterms of it, maybe the maturity date is 5 years time, but maybe in 2 years time, you try to get the capital back. You can actually sell in the market. But this is the tricky part then. The bond price, being to say, like, after 2 years holding the bonds, right, you want to sell, then we will call this, depending on the market condition, we will call it either a premium bond if your bond price is higher. Okay, higher than the par value. Okay, meaning to say higher than the 100 face value. Or we will call it a discount bond if the bond is actually sell at a lower than par value. Okay, so these things I will explain later on why the bond price actually how they fluctuate. Okay, it actually fluctuate according to the market condition. Okay, but just remember, for now there is a two different category of bond. Okay, one being the premium bond, being to say the bond price is actually at higher pricing, and then there is a discount bond, being to say that the bond price is actually lower than the par value, than the 100 ringgit. Okay, so this is actually how we price the bond. Okay, and then from here, we will try to understand then the bond price, how they actually price in different kind of market condition. So just now, as I said, there is two types of the bonds, being one is the premium bond, the second one is the discount bond. Okay, so right now maybe the audience here, maybe you have this kind of questions are like, it's quite confusing. Like just now you say that the par value is at 100, and then right now the price will fluctuate. How is this say so? The reason being is like this, because bond itself, just now we talk about the coupon. The coupon, it will not fluctuate. Okay, bond itself is like we will lend you the money. Okay, we will lend you the money. Let's say we lend you 100,000. Okay, then from there we will get interest every year. Okay, we will get interest every year. At the end of the period, we will get back all of the principal. Okay, meaning to say I put 1,000 ringgit investment. Every year I will get a certain interest. Okay, maybe let's say 5%, meaning to say I will get like 50 ringgit every year. And then at the end of the period, I will get back 1,000 back together with the interest as well. So this is how bond works. So the typical bond, okay, to put it simple, the typical bond, the 50 ringgit interest, it will not change. Okay, it will not change. Forever, it will be just 50. Until the maturity, it will be still 50. Okay, this is how a normal bond works. Okay, but in our economic environment, everything is changing daily. Okay, being to say the easiest way to say it's our interest rate. Okay, our interest rate. Okay, so how to say it's like this. So for example, right now, if I am Genting Malaysia, right now I'm actually raising a bond. Okay, so the first thing first, as a corporate, I will look at the interest first. I'll look at interest. Let's say, for example, at the moment right now is 3% interest. So I would think that me being a Genting Malaysia, having a really good and sustainable business, a very strong branding. So the interest right now is 3%, right? I'm good. I just put up a 4% bond. So meaning to say, if you invest 1,000 ringgit into it, every year they give you 40 ringgit. Okay, until the end of maturity, they give you everything. So I will raise interest 4%. Okay, coupon 4% bond. So you as an investor, right now you'll buy now. Okay, you say, oh, interest 3%. Bank give me FD 3% only. If I buy this bond, I get 4%. Pretty good, right? Okay, I invest. Then maybe after 1 year and 2 years later, before the maturity, right? Right now, a different economy environment. Right now, the interest, when I was raising the bond, right? The market interest, the FD is actually 3% only. Right now, let's say, for example, economy is pretty good. Market is going up. So banks, right, they will do this. Our bank, the government Malaysia, when the market is going pretty good, they will try to control. Okay, they will try to control. They try to stop, not to let the economy grow too fast. Because if it grows too fast, then you will come up a bubble. So it's a bad thing. So what they will do, they will increase the interest rate. So this is what happens like last year time. Our FD is growing up. Our mortgage is paying even higher interest, all these things. So let's say in 2 years' time, interest right now is 5% maybe. 5%. FD is 5%. Okay. So down the road like that, let's say right now you as the bondholder of this 4% Genting Malaysia bond, right now suddenly you have an emergency. You need to sell this bond in the market. Okay, you need to sell this bond in the market. But the thing about it is like the economic environment is no longer 3% anymore. It's 5% right now. So you as the investors, like other investors, you think about it, will you want to buy the Genting Malaysia bond or not? Okay, because if you put it into FD, you can already get a 5% already. FD, FD, you straight away get 5%. Why you still want to put it into this Genting Malaysia bond? Okay, so definitely, in that way, me as the bondholder, then I will have to sell it cheaper. So I will have to sell it in lower price. Okay, I will have to sell it in lower price. So because of that, so I have to bear the losses. I at the beginning of time, I put up 100 ringgit capital to the lender, okay, to lend it. And then 2 years later, because my urgency, I have no choice. I have to sell it quickly. But the economy environment is not good to me. So I have no choice. I have to do it. So I sell it, then I take out the losses of the capital losses. Okay. So this is how the relationship between the price and the yield. Okay. The yield. Okay. Meaning to say, your it's actually they're having a high I miss out a part of it, meaning the interest. Okay. When the interest is actually going up, okay, the interest is going up, meaning like the yield. You can take on yield as an interest. The interest, let's say it goes up for the bond yield, it goes up, like our interest, our OPR, our Bank Negara Malaysia interest. Let's say it goes up, it's very bad for your bond, okay, because your bond price will then drop and it becomes a discount bond, okay. And then the other way around, if the interest actually goes down, okay, the interest goes down, meaning to say right now your bond will then be a different case. It will be much more like an attractive bond, a higher interest bond. Because imagine just now the 3%, instead of going up 5% interest, we go down to 1% interest only. Like back then, our COVID time, 2020, it cut the interest until 1%. Suddenly, if 2 years later, you take up your Genting Malaysia bond, you say that, oh, I want to sell this bond. Thousands of investors want to buy from you because your bond is having what? 4% interest. Right now, if we look at FD, it's like 1% only. So definitely people are crazily want to buy from you. So this is how yield and the bond price works different way. Okay, they works inversely. So we call inversely. Okay. So this is also the interesting part where it is used to hedge against the market. Okay, together with stocks. Okay, this is how we use, because if you look at it even more deeper, you will find that bonds, this is why we say that bond and stocks, it works differently. Okay, because when stocks are going very strong, this is actually the time where like the interest is going up and up, going up and stronger, so your bond will be like not a good value. But if like back then 2020, stocks dropped to like crazy, crash at like 30% to 40%, interest rate cut down everything, our economy is very, very bad. So imagine if that time you already have bond holding in your hand, then your bond will go up in value very high, probably like 30% to like close to 100% also can. So this is how you play around together with stocks as well as bond to try to make up a risk management in your portfolio. Okay. If this maybe can be quite confusing and quite deep, so if you guys have any problems, try to speak up so we can have even clearer explanation later. Okay. Okay, this one I will try to like explain plainly on how we actually look at the coupon rate, the rate, the yield, and all this thing. Okay, so just now we were talking about the yield, right? The yield being to say like the interest lah. Okay, so but you can always look at the other way around, like okay, the yield here is about the interest and how it will look at your price and how it affects. So it will make you easier to understand. Okay, so being said right now, for example, the coupon rate is 6%. Okay, the bond price 100. So this is the time where the bond is actually at par value. Okay, at par value, meaning to say it will be the same price, 100 ringgit. Okay, and then the coupon will be 6% all the time. The cash flow getting 60 ringgit every year until the end of the period, you'll get back 1,060. So this YTM, it's what we call yield to maturity, meaning to say if you hold this bond until the end of the maturity date, you will get 6% return every year. 6% return every year. Okay. So in scenario 2, so you try to imagine, let's say in scenario 1, the interest is actually at this moment, our economy interest is actually like 5%. Okay. In scenario 2, let's say it's a bad scenario. Okay. the interest rate actually from 5%, it goes down. Okay, it goes down to like, maybe 2%, 3%, something like that. So your bond price right now increase. Your bond price increase. Okay, so as you can see, right now it's a premium. So if you look at it, 6%, 1,000 ringgit. If you look into it, YTM is actually lower. Yield to maturity is actually lower, 5.6%. Okay, 5.6%. Because this YTM is calculated as if at this price you invest into it, only the time right now you buy into it, and then it will be a bad thing. But if a different way, if you imagine they try to sell off 101, okay, let's say it buys at 1,000, okay, this 2017 time it buys at 1,000. Let me see. This time they buy at this time by they using this pricing. Okay, you use this pricing to buy. So at the end, you actually, let's say you get 60 ringgit 80, and then you just straight away sell off. In one year of time, instead of getting like 60 ringgit as the profit, you're actually getting 70 because you're having like the 10 ringgit gains. So this is how it comes, coming from the angle as a bond, you are able to get a higher gains when the interest rate down. Okay. And then the third scenario is much more like the interest rate. Let's say right now it goes up from like 5% goes up to like 7%. So your bond will be a bad thing. Okay. If you already invest at the beginning of time. Okay. If you already invest in the beginning of time. So at the moment, the price is actually 99. Okay, meaning to say like the price is actually lower. You have no choice. You have to sell at 99. So you will get a lower return. But if at this moment, if you haven't invested yet, then you will get a better price. So at the end, your yield to maturity, you can see here, 6.4%. Okay, so this is how we look at it for bond yield, and also what is their the potential interest, the potential capital gain, and all of it. Okay. So the 3 ways to make money, just now as I said, the 3 ways to make money is the first thing first is the coupon payment. Okay, just now as I said, you are getting the interest. The second way, the capital appreciation, okay, meaning to say the interest rate movement. If it goes up, you are lost. You are in loss. You are losing. If the interest goes down, your bond will appreciate. It goes up in value. Okay. But there's also a third way, which is the forex gain. Meaning to say, if you are investing into Australia bond, New Zealand bond, or maybe US bond, the currency, when it goes up in value, you'll get extra return from that. But this one, it's harder to gauge the forex gain. So normally we only look at the coupon and also the capital appreciation. Okay. So the 2 key risks on bonds, right, is these 2 things. Okay. And it's especially important for credit risk. Okay. Because if we look at bonds, right, as right now, you know that bonds is almost like just a debt where you give to the company and then they go and spend for the projects, right? But the thing about it, if you look at it, if the company that you are giving it, right, is actually a very bad company, they're having a very bad credit score and they are not earning at all, they're actually losing money. So this kind of company will have a very big risk because you will be worried because they can't pay you back the principal. Maybe they can give you the interest. Okay, first year they give interest, second year they give interest. The third year, they say that they defaulted, they can't pay you the interest anymore because the project fails on it, anything like that. So this is actually a very, very bad scenario whereby we as a bondholder, we should always be careful on this credit risk. Credit risk is the most scariest things for the bondholders, because if the company somehow they have some things going on, right, then you might lose everything. Okay, you might lose everything. But as long as you invest into the bonds that actually having a very good credit scores, like you are investing into very well-known companies, Genting Malaysia, Top Glove, Maybank, and all this. So basically, you are not that in kind of situation. So as long as you try to avoid what we call the high yield bond, okay, the riskier bond, okay, so then you'll be safe from that, okay. And then the second thing is the interest rate risk. So this one, just now as I explained, the interest rate risk, because as the interest rate is in different condition, okay, as we are in different economic condition, maybe right now it's very, very good economy, the interest going up. So your bond will then looks like very worthless, because in another way, I can just simply put into FD will do. So if right now suddenly you have liquidity issue, you try to sell your bond, you have to take losses, because that time nobody's want to buy from you. So you definitely have to lower down your pricing. So this is two key risks for the bonds like that. Okay. Okay. Now we'll look at like if. Oh, sorry. Okay. Oh. Okay. So normally when a company is, let's say they actually default on your bonds, so what will happen to you? Basically, if let's say a company they suddenly defaulted, like for example, in the past 3 years, definitely you guys know about the Serba Dynamic. Serba Dynamic is the one that actually defaulted their bonds. They are not able to pay back the bonds to their investors. And then this is what happens is like, then the company, they will start to be investigation. Okay, then they will slowly look into what kind of assets they do they have. And then at the end of the day, they will sell off the assets into cash, and then they will give you by orders of this. So you as the bondholder, you will first get the capital. Okay, you will first get the capital, then only is the preference shares, then only the last one is the equity. Okay, so because of this pyramid things, bond is always considered to be safer as compared to equity. So part of it is also because of this thing. If the company is going bankrupt, you are the first one that actually getting the company value first. But definitely, you don't want this thing to happen to you. Okay, because let's say it really happens, usually the company is really in a very shitty scenario, and then definitely you will not get any kind of value anymore. So basically, you will get a lot losses anyway. So you really don't want to have this kind of thing happens to you. So most of the time, when I talk to my clients, when I talk to my students, I always tell them this: bond is a very good thing, but keep in mind you will always have to be very careful on high yield bond, high interest bond, because those kind of bonds are the one that you should really look into it very carefully or try to just avoid it, because if you want to avoid this kind of risk. Okay. Okay. So the benefit of investing into this kind of bonds, okay, the benefit of it is actually, let's say you understand about, as I explained about all these bonds things, there is some of these benefits pretty good. So the first thing first being they are able to fight against inflation. This is almost acts like your FD, acts like your fixed deposit. Being said, your fixed deposit, they always give you like 3% to 4%. But you invest the bonds, right? Usually they give you higher, around like 1% higher or 2% higher. So you can fight the inflation even better for that. Then the second benefit, I would consider this is the best one, because asset diversification, meaning to say, using bonds and stocks together, you will have a really, really good asset diversification. So in all kind of economy scenario, right, you don't really have to worry anymore. Like if you put too much into equities, right, you have to be worried, because if 2020 some kind of a stock market crash, right, happens, right, then your portfolio value will be in very deep trouble. But if you having bond in hands, right, then it will be a different story, because the market will crash down, the interest rate will cut down, but your bond value, holding the bond value, they will go some in value. And then from there, you are able to sell your bond from them, buys on the low price equity, buys on the low price shares, then you will be in a very good spot for your portfolio value. Okay. And then the third benefit will then be the cash flow planning. Okay, the cash flow planning. Okay, this cash flow planning it's much more like for the retirement planning. Okay, retirement planning. A lot of times, this is all very critical questions. A lot of time when I deal with clients, like they are trying to plan up their retirement funds. So we as Malaysians, a lot of time we ask this kind of question to ourselves, like I want to retire. So, but how much of the retirement funds I need? Okay. So always here I put up a very easy explanation to them. So I always say that what kind of a lifestyle do you want? Okay. Is a month 5,000 of capital, 5,000 of budget, is it enough for you? So some of them will say okay, some of them will say, oh, 5,000 not enough because I want to go for like very luxury types of lifestyle. I want to go vacation, all kinds. So instead, all kind of different ways, we just take 5,000. So then I will say 5,000 per month. Let's say per year type will then be 60,000. Okay, 60,000. So 60,000 1 year. If you are able to invest into a bond, maybe 10 years bond or 30 years bond, that can actually give you a fixed interest, let's say like 5%, okay, for 30 years. So easily your requirement for your retirement, your retirement funds will then be just around like 1.2 million. Because if you have 1.2 million, you straight away invest into this 5% bond for 30 years, you will easily get 60,000 every year. And then your retirement will be covered already. So this is one of it, like what we call cash flow planning. Like how can you use bond as a tools for you to actually plan up your retirement funds like that. Okay. And then the last benefit of it is saving mechanism, meaning to say instead of saving into FD or just put into banks, most of the time I will encourage people to just save more into your bonds so you get higher interest. Okay. Oh, wait. Okay, so here I try to compare a little bit between like bond versus fixed deposits. Okay, so most of the time I would say bonds are definitely a better things because if you look into it, there are a lot of features that actually bond has, but fixed deposit they don't have. So the first thing first being like the capital appreciation. Okay, so fixed deposit they don't have this thing. Fixed deposit the FD they always just give you the interest every year. That's it. End of story. For bonds, then it's a different story. It will goes on according to your market condition. If your interest rate somehow your economy is going down very bad, your interest rate is cut down, so you have the opportunity to sell your bond. Okay, sell your bond in Bursa, and then you're able to get a higher capital appreciation. Okay, but of course, insurance-wise, bond is not insured, meaning to say there is no guarantee. Okay, there is no guarantee. Okay, fixed deposit is insured, but up to 250,000. Okay, by PIDM. Okay, for liquidity it then will be by offer in the market, meaning to say like if you want to sell, definitely if there is a buyer that is willing to buy from you, then you're able to sell easy. But for fixed deposit, you can do so. Okay, you can do so, but you have to take up the cost of forfeited interest, meaning to say your interest will then be kosong. Even let's say your interest, you wait for like 8 months time or something like that, it will be kosong definitely. Okay. Returns wise, normally bond is higher. FD is basically very low. Like right now, we are talking about FD being like 4%. Okay. Our interest rate is 2.75. Our FD is around like 4%. For bonds, it can comes to like a very good bond like MyEG bond or maybe Genting Malaysia bond. Genting Malaysia bond can come to like 4.7. MyEG bond can comes to like 5.8, something like that. Yeah, so that is the best thing. It gives out very good returns as compared to FD. Okay. Okay, but this is also another comparison. Okay, this is also a very good comparison, which is the bond versus bond fund. So if you guys actually invested into unit trusts, a lot of times you can come across this bond fund as well. So what are the difference? Okay, is bond funds also the same thing as bond? It's actually not because bond itself is actually an individual bond. Okay, bond itself is an individual bond. Being said, if you're buying a Genting Malaysia bond, it will be just Genting Malaysia bond, one thing. Okay, one kind of bond. Bond fund, another way around. It's much more like a collective fund, a pool of fund invested into different kind of bonds. Okay, so there is a lot of bonds there. Okay, so for these two bonds, it will be definitely a difference between their features. So the first thing first being the certainty of cash flow. Okay, the cash flow. Okay, because for individual bond, the certainty of the cash flow is definitely 100%. As long as the company don't default, okay, the company will just stay on in business. It will definitely be 100%. It gives you the interest on that date, and definitely it will give you. Okay, but bond fund itself, it's not certain. Okay, because a lot of different fund manager. Okay, because you're having a pool of fund managed by a fund manager, managed by an expert. So what they do, they have different kind of strategy. Maybe they will trade the bond. Okay, they will buy and sell the bond, or maybe sometimes they will just hold on the bond, but particularly for maybe for like a 1 year time, 2 years time, then they will do selling and buying again. So there is a lot of different kind of strategy in bond investing. So because of that, right? So you will not have like a certainty things like definitely the funds will gives you a bond interest on that particular date. No, sometimes maybe they drag. They do give you income distribution, but sometimes maybe they'll drag a bit here, maybe drags 1 year, maybe drags 2, 3 months, something like that. So it's a not a certain things like that. Okay, but definitely for bond fund in terms of diversification, it's definitely a good thing. Okay, because you are investing into a lot of different bonds. So even one bond's default, right? You don't have to worry much because maybe they affect your value probably like 2 to 3% only. But let's say for individual bond, you only invest into that particular bond, and that company actually defaulted. So your whole capital, your whole principal basically is accounting. So this is the difference between a bond and also a bond fund. Okay. Okay. Then where are the bonds actually traded? In Malaysia, being said, our bonds, most of our bonds basically trade over the counter. Okay, so what does it mean over the counter? It means by offline method. Most of our bonds trade in over the counter, being to say by offline method, you only have to get the bonds when you actually go to the bank and ask the bank about it. We don't really have like a platform, okay, to show up all kind of bonds there, and then just you can just Google it and just trade something like that. Most of the bonds, but Bursa actually they come up with a new platform where you can actually find all this kind of bond, meaning to say exchange traded bond. Okay, exchange traded bond, like our topic today. So, but back then, like 5 years time back, 10 years time back, it's always like over the counter bond. You need to say only by offline method, and a lot of time these bonds are very huge in value as well. Okay, because bonds in Malaysia, one bond is particularly worth like 250,000. Okay, 250,000. So normally what we call is like one lot. Okay, one lot of bond, it's 250,000. So usually if you trade over the counter, right, it will be a very expensive thing. So this is how they works out. Like you go to the counter and then you say that you have maybe 1 million and you want to invest into bonds. So you are the buyers, then you will actually being approached by a dealer. So the dealer will actually help you to find the seller, something like that. Then they will try to give you the bonds, to make the deal. But usually this kind of thing is very, very expensive for standard lot. Okay. But just now that one is over the counters. Okay. But right now, as for our Malaysia, Bursa Malaysia, we do have like this platform over the exchange, meaning to say you just log in into your account, or you go to this platform, okay, and then you can search up the bonds available in the company, okay, in the market. Maybe like if you want to search up for Tenaga Nasional, then you can search up whether they have this bond or not, whether they have this company bonds or not. If there isn't anyone, though, that means no one is actually selling, because for this kind of over the exchange, meaning to say it's much more like the secondary market. Like if there is a buyer in there, then there is a seller in there, there must be a buyer in there, then only you can get the bond, something like that. Okay, so right now our Malaysia, Bursa Malaysia is actually getting better and better for this kind of platform. So there is more and more liquidity in the platform also, and to be honest, it's a very, very good thing. It's a very good progress as well, and hopefully people are getting well known, better understanding about how bonds works, and push up the trading volume for the bonds. Okay. And then we will come to buying and selling on Bursa Malaysia. So just now, as I mentioned, right? So Bursa Malaysia, they actually have this platform that actually can, buy over the exchange, meaning to say buying or selling in the Bursa platform, something like that. Okay, so if you want to buy a bond, right? So definitely there's two ways, like primary market or secondary market. Primary market, that means like a subscription, you subscribe the company bond, they first put up the bond, something like that. But usually this kind of primary market is very, very high, as I said, like over the counter kinds of things, like 250,000 for one bond particularly. For secondary market, that means like you are selling, like selling shares, things like that in the platform. Okay. Then selling is also the same thing the other way around. Okay. Just that you right now, you instead of buy, you are selling. But most of the time, if you are sell, that means only for secondary market, only for secondary market. You can sell the bond before the maturity, but if you held the bond until maturity, then you will only get back the principal. So that's it. You don't have to do anything. You just hold until the maturity. Then Bursa will help to clear off everything and then give you the principal back into your account. Okay. And then so you are able to trade, all this bond in their platform. Okay. So basically in the platform, there is different kind of sectors. So as I said just now, there is a bond, conventional bond, and also Islamic bond. So Islamic bond is what we call Sukuk. Okay, so you have to choose the right sector as well, because it will have like different kind of availability also. Okay. Okay, this is, for example, okay, how they actually structure it out. Okay, how they actually structure it out for the bond. Okay, so fixed income is actually listed and traded on the exchange, Malaysia, Bursa Malaysia platforms. Okay, and then usually you can able to search. If you, let's say you try to search on, this is the stock code of it, like the bond code of it, from the issuer Anson Tan. Okay, and this is the listing date, 8th of August 2017, maturity date 8th of August 2024. Okay, what are the tranches value? Tranches value being to say it's the total value of the bond. So you can also compare this, like, is this bond very huge for the company? If let's say, for example, Anson Berhad, this company itself is having like $1 billion in assets. So you understand. So this 5 million is actually a kacang putih to them. So you don't have to worry. They can actually pay off this bond very easily. Okay. Tenor, meaning to say the maturity time. Okay, 7 years. Yield. Okay, right now if you invest, is 4.6% every year. So this is how we look at the bond, and then try to buy and sell and all these things like that. Okay. Okay. So here we come to like, how do you find information on bonds? Okay, so to find information on bonds, right, it's very different things, because for stocks, usually we go for this KLSC screener. So in that kind of a platform, you have all kind of information, and the news, the dividends, and all kind of their quarter report and all these things. But for bonds, right, it's a totally different view. Okay, this is some things that if you guys want to learn, you have to really understand about bonds. It's like you have to have a different perspective on bonds. Okay, because for shares, right, let's say we are investing into shares, we are actually looking more onto the potential upside, like if the company, whether the company can grow bigger in terms of business, or can grow even higher and sustain, then they give us even higher dividend a long time. Okay, so in terms of shares, we will use this kind of perspective to judge whether the company is good or not. But for bonds, right, there will be a totally different perspective, because you don't care much about the growth. Okay, you don't care much about the growth. You only look at the sustainability. Okay, so I repeat, you only look at the sustainability, because the company can be in a very shitty industry. Right now, it's a very bad moment for them. But as long as their business is able to sustain all kind of challenges, right? So this is also considered as a very good bond also. So for example, like the glove companies, okay? Like the glove companies. So if you look at the glove shares, right, it is very, very bad in price, okay? Because they are having a very challenging prospect. Their company is, not making money. They're losing, probably for the first time in decades. So it's a very, very bad moment for their shares. Okay, but for this kind of gloves makers bonds, right, it will be a totally different things, because the amount of cash they are holding right now, right, is definitely able to just pay off the bond easily. Okay, the bond, maybe they actually raised like a few years back then. Okay, right now some investor, they want to sell. So if you ever come across like top glove bonds, right, so I can say that it's a very, very good bond, because basically, if you look at the sustainability of it, they can definitely just pay out easily. They have a lot of cash. Their business is in still in operation, and they have a lot of big assets and all this thing. So basically, you can understand on all this. So this is how we look at bonds in terms of their perspective. Okay, but how do we find information? Like, how do you really look at all this information? So as I said just now, stocks is look at the KLSE screener. So for bonds, right, then we look at this BIX Malaysia. Okay, BIX Malaysia. Okay, so they will have all kind of news more purely on the company's sustainability, and also the analysis on the company's sustainability. And then you can try to read on, what their views are. Maybe because of their credit rating is higher, uh, their cash flow is very, very good, their assets is huge as compared to the value of the bond itself. So all these things are a plus point as compared to like how we analyze for bonds. Okay. So here, if you look at into this bixmalaysia.com, right? So you can go into that kind of website, and then you can just search. Okay, like right now you can search different kind of category, okay, different kind of subcategory rating also. Maybe you can go for a different kind of rating, higher rating, AAA rating. Then it gives you a very, very good bond and all these things. Year to maturity, you can change, like you can accordingly to your years according to your like years tenure. Okay, maybe you want a 5 years time only, you want 1 year only, you want 2 years, some people want 10 years retirement. So you can just choose on your own uh, risk profile, okay, in this BIX Malaysia. Okay. Okay, then we almost come to the last part of the bonds idea. Okay, so just now as we explained, most of it is more about like what is bond about, what is their features, and how they really price, and what kind of bond and all these things. So right now we will talk about like how do we really invest into bonds. Okay, how do we really invest into bonds? Okay, so as I mentioned occasionally, so into bonds, right, we will have to get the perspective of sustainability. Okay, so in terms of sustainability, there are like three big parts of it. So being the first one is the business nature of the issuer. Okay, the business nature of the issuer. How do we say business nature? To put up a simple comparison, we compare construction company and Genting Malaysia. Okay, so definitely Genting Malaysia is the one that is having a better competitiveness compared to the construction company. The reason being is because construction company usually they will complete up the project, then only they will get the cash. Okay, they will always like complete the project, then they only get the cash. So being to say like their cash flow is not that good. Okay, but for Genting Malaysia, it's a total different thing because their business nature is much more like they will get the cash straight upfront. Okay, gambling, hotel, or even their tourism and all this thing. So they will definitely get the cash back first. So in this kind of business, you will definitely know because this kind of business they are cash rich. So being say they were able to easily just pay off your bond, so you don't have to worry about the bond interest. Okay, so the second thing definitely you have to look into is their financial profile. Okay, meaning to say like whether they are healthy in terms of how many cash they have, how many debts they have, maybe their asset, is it big asset, is it small asset, or maybe they have like a lot of different hanky panky things, like a lot of time their cash flow is always negative. So this is also a bad thing. This is what happens to Serba Dynamic. Like their financial, they're having a huge debt. They always having bad cash flow. So this is like a signal to you. This is not a good bond for you lah. Okay, it's a riskier bond, something like that. Okay. And then the third one, this is also very important because this is what happened only like last 2 months like that. Happens to this Credit Suisse bond. Okay, what we call the AT1 bond. Okay, the structure of the bond. Okay, because as I explained just now, from the beginning until now, right, I only explained the simple idea of a plain vanilla bond. Okay, meaning to say just a straight bond. Okay, giving you interest every year, and then by the time of maturity, they will give you back the principal. But if you try to understand more about bonds, right, you will find that bond they actually have a lot of different complex structure. Okay, sometimes they call it step up bonds. Okay, step up bonds is to explain it simply, it means like they will have a period. Once it's over the period, they will give you the coupon rates every year. Maybe right now they are giving you 5%, but right after the particular date, they will always give you higher interest rate. Let's say by 1% every year. So your coupon will be then from 50 ringgit every year becomes like 60, 70, 80, 90, and 10, something like that. But this kind of bond is very bad because if you know that they have this kind of things, meaning to say it's actually it's higher, it's a higher return, it's a good thing, but meaning to say because the company credit is much more weaker, so they try to put up this kind of features to attract more investors to invest to them. So they have different kind of bonds, like the Credit Suisse bond is what we call the Coco bond. Coco bond, it's much more like if anything happened to the company, they have the right to just default the bonds, and you guys are not able to claim ownership or like try to claim value from the company. So this is also why the AT1 bonds, when it defaulted, right, when Credit Suisse actually defaulted, there's like a 10 billions of bonds just like disappear, something like that. This is what we call Coco bond, because this bond is actually structured in a way that if something happened to us, we have the right to just default and don't have to pay you anything. Even you go to the legal firms, you try to claim, there isn't anything you can do so. So this is the bond, how they structure it out for the Credit Suisse bond. Okay, so you have to be very careful on the structure of the bond. I will say always pick the easiest one to understand. Just pick up the plain vanilla bond. Just pick up the straight bond. That will be the safest. Okay. So I almost come to the end of this bond section. Okay, so a key takeaway for today's section is bonds. It is much more safer compared to stocks. Okay, the reason being because the return is constant. Okay, the return is certain. You basically know when you are going to get the interest, and you don't really have much volatility as compared to stocks. Stocks, even a good dividend paying stocks, let's say by one day I face a lot of challenge, I can also choose to not pay you the dividend. Okay, but bonds, no. Bonds, definitely you have to get the coupon. Okay, and then the second key always is default and interest rate risks can be mitigated. Okay, default and interest rate risks can be mitigated as long as you try to control your your risk appetite. Okay, if you are having a conservative kind of a risk profile, always try to go for the high rating bond. Okay, so your default risk is low, then you don't have to worry anything. Okay, interest rate also, if you're having like a fixed tenure, most of the time it's like that. If you're having like 5 years investment time, just put on 5 years bond. Try not to get like 30 years or like 10 years, all kind of this kind of thing. So if you're having 5 years tenure, just put up 5 years bond. Don't go and take up a higher bonds like that. And then the last one is being stable and predictable source of income. Okay, because bond, you have the certainty when the cash flow is coming in. So that's why for bonds, it's a much more stable investment as compared to the other investment vehicle. Okay, so I will finish my sharing section right now. Okay, so we'll go into the Q&A session. Okay, Kaman, back to you.
All right. Yep. So, yep. Thank you. Okay, sorry. Yep. Thank you, Divo, for your sharing. It was a really insightful one. So we do have few questions on hand. Okay, the first one being because you talk about, discount and premium bonds. So there are people who would like to understand further, in terms of investment, should they actually purchase, discount or premium bond? Like which would be a better choice for them?
Okay. There isn't a one to all answers for this kind of questions. It's more like looking at your risk appetite, because I would say sometimes a premium bond is a good bond also, because if you look at it, sometimes it's much more like they have different kind of intention. Sometimes they look at the company and then they think that the company having a really good brand and having a really safe risk, right? So then they look at the premium, they don't actually afraid of it, as long as the yield, the return to you, the YTM, the yield to maturity, is actually comfortable. Like maybe premium bond at 101, but somehow your YTM is around, your yield to maturity is 4.5. And let's say I'm comfortable for 4.5, I'm good. So I will take it anyway. But definitely, if you are a much more like a risk taker, okay, you are much more aggressive. So you should go for the aggressive bond, because that will actually give you a higher yield to maturity. They can give you, because you are buying at a lower price, and then they give you a higher coupon as compared to a lower price like that. So from there, you're able to have a higher return at the end of the day. So this is like how whether your risk profile is suited to that kind of a bonds or not.
Right. So thank you for your answer. Moving on to the next question. Someone actually asked, like, upon maturity, so the amount of return that they will receive, will it be on value upon maturity, or is it on par value?
It will be on par value. Okay, it will be on par value, meaning to say the par value actually is the maturity value. Okay, so the par value is 100, so they will always give you 100 at the end of the maturity. There isn't any like maturity value and then it will be a different value. No, it always go back to par value. So this is also an interesting thing, whereby if you buy a bond, it has a very, very long period, right? Interest rate, when it change, right? As I said, interest rate when it change, right, your price will change. Okay. If the tenor is still long, your price changes will be even significant. For example, if let's say right now the bond is actually having an 8 years time, but the interest rate actually hike up a lot, so your bond will then be really, really in bad value, in terms like maybe your bond price even can go down to like 70 or 60 or 50. So it will be a very bad thing if you sell at that period. But as you goes on, it comes to closer to maturity, you will see that the bond price will easily goes up because it goes back to par value, hundreds. So this is also the reason why I say, like, if you're having the tenure of 5 years, always just invest in 5 years. So even some things like this happens where you don't have to worry because you know that, oh, I can, I just put up 5 years and never mind lah. So you don't lose anything.
All right. So for the third question, so someone actually mentioned that, equity and bond is not really performing well last year. So is there, any correlation between both equity and bond in general?
Okay. Typically to say their correlation is much more like a negative correlation, meaning to say, like, if equity is going good, bond is basically going down. If equity is going down, then bond is actually going up. But I would say last year, not to say only last year, to be honest, 2020 until even right now at the moment, it's always like a really weird period whereby if you look at the historical data, whenever we have like market crash, right? The bond price will goes up in value. The equity will be in very bad. So that present the negative correlation. But only in 2020, whereby we have what we call this liquidity crunch. A lot of people, they actually just sell off everything because this is like the first in probably like 2 decades or 3 decades, something like that. So the first thing they only look at some kind of a virus that can actually be so infectious and everyone is getting it. So this kind of thing is actually like it's almost like a war whereby it hides up the panics and everyone is selling everything. So because of that, only in 2020 you can see equity and bonds actually go down in value together. But if you talk about like last year, right? Last year I would say it's much more like because of the interest rate as well. Equity going down, yes. At some point of time, it's because interest rate is hiking up at the wrong timing because our inflation is too high. So somehow we have to hike up our interest rate very, very quick. So equity is having the pressure of it. So interest rate hiking, right? Bond is actually in bad things also. But in normal economic circumstances, right? Normally, if our economy is going strong, meaning to say growing stronger and stronger, then only we'll try to increase the interest rate. From there, equity, you can see that equity is really hike up quite a lot from there. You really earn up quite a lot from equity. Yeah. So this is what happened to like last 2 years and 3 years like that.
All right, I understand. So to follow up again, so does it mean that it really highly depends on the economy itself? In any case, perhaps you can elaborate further, like, who are the market makers in general, and how do they operate? How do they affect I would say, the rise and drop of the whole view of maturity itself?
It's more like, as you can see, it's more like the demand and supply. The interest rate is the one thing that actually affecting the bonds. Okay. If you look at plainly on the economy value, it's more like even, for example, even we say that last year equity is bad, but you have to remember equity in terms of 2020, end of 2020 until like 2021 is pretty good. So that time also is the different way whereby bond is going normal and equity is going up. So this is also the things that it's more on demand and supply and different kind of a market circumstances. Being said, like interest rate when it goes up, right? Definitely people are not going to look at bond anymore because when we look at our FD, we will have even better interest and easier to understand. For bond, we have to go and study their credit risk and all these things. So it's much more difficult to invest into that kind of a period. So, but the idea is like, if the interest is higher and higher, then bond issuer, they will have to give up higher coupon as well. So this actually comes with like demand and supply, being to say, if the interest rate straight away hike up, right, in a very fast pace, it will be very bad for bonds. Okay, but once it's stabilized, right, at the higher period of higher interest rate, then from there you will see that bonds actually comes up with higher value of bond, higher interest, higher coupon. So the demand will then suddenly and coming back here again. So this is always like looking at the condition of it, not to say like just yeah.
Right, understand. So there's actually not much time, but I think we can take 2 more questions. So there's one, because from the example, it shows that but based on the value itself, the bond value is actually pretty high. So as a retail investor, if they're looking for small capital bonds, let's say maybe around like 1,000, how do they go about it? Is there a way that they can actually invest that amount instead?
Well, for this, right, basically, I would say, unfortunately, if you want to look at like particularly bond, right, individual bond, there isn't for a capital as small as 1,000 because for a standard lot of bonds is 250,000. So it's very hard for you to really invest into an individual bonds. But what you can do is actually you can invest into bond funds where bond funds, they do have this capitals requirement just as low as like maybe 500 or even 1,000. Okay, so if you're using just this kind of a capital, then you can just straight away go for bond fund. But definitely bond fund, as I said, the difference being you will not get the certainty of the cash flow. But in terms of 1 year time, they will definitely give you the income. They will give you the income distribution. It's just more like you will not really know the fixed period, like maybe on this date itself, I'll definitely get it. No, you will have the bond effect, meaning to say like interest rate when it goes up or go down, you are able to have it. But the certainty of it is much more lower than, yeah.
All right. So, yep. So for the last question, okay, they ask how to distinguish bonds versus preference share. What's the main consideration by issuer on these two different fundraising methods?
Okay. This is actually a really good comparison. Okay, because a lot of times preference shares is almost like the same thing as bonds because preference shares, they don't have the ownership of the shares as well. Because they don't really have like dividends or like capital appreciation and all this. They're only getting fixed interest, okay, and bonds as well also getting fixed interest like that. But the key difference, I would say, it's much more. They are typically the same thing, but the key difference is much more like tenure. Okay, tenure is the one of the key things for bond and preference shares. Being said, preference shares, to be honest, preference shares, they don't really have a fixed maturity. Okay, preference shares can be a perpetual things. Okay, only, let's say for example, the issuers, they always, when they issue preference shares, like especially in Malaysia, they always issue this kind of redeemable preference shares or irredeemable preference shares, something like that. Meaning to say they actually can call back anytime they want. So this kind of preference shares is much more like, they if they have the capital, then they call back lah. But if let's say just a normal plain preference shares, right, they always go in perpetual, meaning to say you have to pay the holder forever for the interest. But also another thing is whereby the capital appreciation as well. Being said, bond, the interest rate changes will actually change the bond price. Okay, so meaning to say there is a hedging mechanism there. Okay, when interest rate is down, very bad market, Bank Negara Malaysia cut down interest rate, then your bond will then increase in value. Preference shares, no, they don't have this kind of thing because they will just give you the fixed interest and that's it. You can't trade it. So this is also one key point for preference shares and bonds. Yeah.
All right. So, yep, thank you for your sharing. So I think with this, we will conclude today's session for today with Divo. So I do hope that everyone here did learn, a thing or two regarding this whole topic today. So, yep, I think once again, we can all just draw in our challenges right there. Thank you to Divo, okay, for today. And really, once again, thank you for joining us. So before I proceed, okay, all right. Yep. So before, right. Okay. So I think before I